Hi everyone, thanks for joining us to discuss the markets, the macro and the portfolios. There's a lot happening and we'll try and keep it short. Firstly, portfolios since inception, you can see here our high conviction balanced growth portfolios have returned 309, 304, 349% respectively after fees compared to the market 216% since we started investing these strategies in 2010. For those who don't know, and I'm sure most of you do know what we do, so we'll keep this short, but we look beyond the well-appreciated stocks in the market. We like to own high quality companies. We like to find them early when we can invest in them at a relatively cheap valuation compared to their future growth potential. And we like to be aligned to quality management who have a high percentage of share ownership. The founder-led companies tend to be the best performers in the market, and especially the high growth founder-led companies. They're the ones that have delivered great returns for us in the past, and we're confident we can keep finding them in the future. We do our own valuation work. We think the combination of doing our own numbers combined with that direct line into the CEO or the CFO when possible really is the secret sauce and gives us an edge in the market. Now, if we look at the performance since inception here for the growth and balance portfolios, you can see since the period between 2021 and 23, there were flat returns and there was volatility within due to what was a concerning macro environment for most at the time. Now, I put in the August newsletter that one of the most detrimental things investors can do is to switch strategies during a downturn. And we understand it's hard to react to macro events, but since last October, when macro concerns were probably at their peak, the All Ords has bounced 23%. We can see in this grey line here, and the growth and balance portfolios are up 25% each. The high conviction portfolio, since we also changed portfolio manager at the same time, I took over running this portfolio, supported by Joe Carlton and Dan Gaffarini, who have been a lot of help on this portfolio. Since that period, it has returned 27%. Now, we'd love to take full credit for this bounce back and return to outperformance, but obviously the market has also rallied and we're back to a normal operating environment as opposed to the 2 years prior where small caps were selling off, high growth, high quality was also in a downturn. We are now in a situation which we think is a Goldilocks environment for equities and especially small caps. We'll talk about that a bit later on. But in short, we're seeing reasonable economic growth and a rate cutting cycle which started today from the Fed. We're confident in the near term and medium term performance of all our three strategies. You can see on this slide, last month in our video update, we said we feel we're well positioned coming into August. And August and February are 2 months where we should really be judged as fundamental stock pickers. The fundamentals shine through of these quality companies and high conviction and growth portfolio returned 1.7 and 1.9% versus the market 0.4, and the balanced portfolio was down slightly, down 0.3%. You can see the 1 year numbers here between 13.3 and 16.2%, and obviously the inception numbers are looking good. Now, what are we seeing in the market? We'll keep this short, but there is a lot to discuss. Last month, this is a chart of the CPI. US in grey is declining. In last month's video update, we said the market is pricing in some hikes in Australia. We can't see it coming. We think Australia will follow the Fed and be forced to cut rates. Here we are, the latest data. Australian CPI has rolled over, it's declining. We think that'll continue over the next 2 months, and US CPI has declined into the Fed's target band. Now, the rate cut this morning, 50 basis points, shows how hard it is to predict central bank actions and the economy. 104 out of 115 economists that were surveyed about the rate cut got this result this morning wrong. 50 basis point, most expected a 25 basis point. Now, a lot of investors are wondering why the Fed is cutting, why central banks are cutting. And the main reason is because the labour market is softening. Now, what we're seeing is not a soft labour market, but we're seeing unemployment slowly increasing. And the reason for this in Australia specifically, but we're seeing a similar dynamic in the US, the reason for unemployment increasing is the participation rates going up. So we have more people looking for jobs. We have more jobs being created. We just have more supply than demand. So it's not, this increase in unemployment isn't concerning because jobs are being created, because the economy is in relatively good shape. We've got a lot of immigration in Australia, which is helping this participation rate increase. So it's a fairly healthy dynamic at the moment. Those long-term sort of investors will know previously 5% was about a stable range of unemployment, and we're tracking back up towards that range after a very tight employment market following COVID. Similar chart here, not much needs to be added. We can just see the COVID spike, which has declined. Forecast is for a fairly flat unemployment rate. So we've seen a rate cut today from the Fed, 50 basis points. The RBA will follow. Now, how does the market perform following a rate cut? Well, it depends on how the economy is performing. You can see 01 and 07, obviously we had a recession globally and we saw a negative market reaction, but it's not always negative. If we're seeing a rate cut, which can often happen at all-time highs in equity markets, followed by stable growth, there actually has been positive performance for equities in the past, which makes sense. There's more stimulus coming through, valuations increase. A lot of companies are supported by the rate cuts that we're seeing. It's also presenting opportunities. Now, at Endeavour, we're always hunting for high quality industrials, and they've been our biggest contributors. Companies like Altium, Imdex, WiseTech, Xero, Life360, Zip, even Lifestyle in the early days. These quality industrials we can find early and let compound over a long period do generate great returns. But we're also generalists. We look at all sectors on the market and we will hone in on sectors we think are mispriced, which is occurring in the commodity sector at the moment, in our opinion. In August, we were underweight, significantly underweight commodities. That helped us outperform relative to the market. And we've recently doubled our exposure. We're now at market weight. And I've got a few slides here just to show how poor sentiment is. This one speaks for itself. It's the commodity index versus the S&P 500. All-time lows. In Australia, we see that materials index is 22% below the ASX 200 index. We've seen positioning here is underweight commodities at a 7-year low from investors. In the ASX, half of the top 20 most shorted stocks are commodity-facing companies, and 75% of the top 20 companies are in the materials or energy sector. We don't often see this. It's just an indicator that the market is short the cycle, the economic cycle. Commodity producers are a great way to short the cycle. And a lot of this weaker growth we've been seeing in, say, GDP more recently and disinflation coming through is coming from China. Now we think China will be forced to stimulate. So bad news is good news in China. But they'll probably wait until after the election so they know if they're dealing with tariffs or not. So over to a few investments. We'll just talk about a couple here to give you an idea of some recent changes we've made, that we have made, and some recent picks and some of our highest conviction ideas at the moment as well. So over to you, Dan, first of all, to talk about the real estate investments, of which we previously were at a 0% weighting.
Thanks, Aidan. Yeah, exactly. As you said, in the past we've been underweight real estate, but basically our view changed over time. The expectations surrounding the broader property market, in particular office real estate, were very pessimistic. We took the view that interest rate expectations would stabilise, begin to decline in the next 6 months. So we took that view and expressed it through 2 new investments, one being Charter Hall Group, another one being Growthpoint Properties Australia. Charter Hall is a property funds management business. It's diversified across a broad range of property exposed funds from retail, industrial, office, social infrastructure. They put out a really good result in FY24. Basically, EPS exceeded expectations. FY25 EPS exceeded expectations, and the dividend was better than expected as well. Accordingly, share price went up 14% in August. Off the back of that, we started selling into that positive share price performance because although it was good in the short term, we thought the valuation was becoming a little bit more stretched. So we'll continue to monitor that and wait for more compelling valuation to re-enter it. The other company, Growthpoint Properties, They have a direct investment exposure in office and industrial around Australia. When we were buying that was trading on an 8.5% dividend yield. It was 36% below its book value. We didn't think that book value had too much more declines left in it. So we thought the downside was very well protected. That's responded well out of the FY24 result. Basically, expectations sentiment is starting to become positive in that one. And then additionally, there's a little funds management business division within that as well that we think could offer upside potential sometime in the future.
So just to summarize, we were at 0% weighting in the portfolios for property. We were watching and researching for at least 6 months, almost all the companies on the ASX. We narrowed it down to Charter Hall and Growthpoint. One very high quality, Charter Hall, high valuation, but clean exposure, no debt. And Growthpoint, which was a cheaper exposure, trading a big discount to NTA, paying a healthy dividend. And we waited until we thought we'd seen the low in this sector. Sentiment was very poor when we invested, but we're seeing a leading indicator from the US. The REITs were all rallying strongly when the Fed was forecast to cut rates. Meanwhile, in Australia, rate hikes were expected, and we thought that was the opportunity because we expected the hikes to turn to cuts, which is what we've seen play out, and a bounce in both of these companies. We only hold Growthpoint now because Charter Hall hit our valuation target very quickly. Over to you, Joe, on Johns Lyng. We can't always talk about the winners. This is one that hasn't been a good contributor, but worth discussing.
Yeah, so I'm sure many clients be familiar with this name. It's a Victorian-born insurance building and restoration services company, providing those services in Australia and North America. So we were attracted to this company in 2023, so last year, because we saw the core business growing and we saw an expansion growth story coming out of the US. And earlier this year, our analysis and channel checking saw our internal valuation decline and saw us concerned about consensus expectations. So this changed our investment thesis. We exited the stock for a similar price to our entry price. And since our exit, the stock has reported earnings that disappointed and has traded down 41% since our exit price. Despite this, we continue to follow the stock. We think the company's scale is difficult to replicate overnight. We're just looking for those signs of earnings to trough.
That's right. It's been a poor result, poor execution by management. It will be difficult to get through the process from here until we do see a turnaround in momentum, but everything has a price, so we're watching it closely. Zip has been a great contributor for us. Investors, clients will know it well, so we won't reiterate the process. It's been a good performer. Following the August result, our internal valuation has increased. We previously had it at $2.20 to $2.30 was the range. We've been trimming fairly aggressively. Our internal valuation is up to $2.60. But having said that, we're still taking profits. Clients will see in their portfolios as a much lower weighting, about a quarter of our initial entry point. Smart parking, Joe, this is one of our highest conviction ideas. Do you want to have a quick chat?
Yeah, that's right. So going back to what Hayden said at the start of this presentation, this company aligns nicely with our investment principles: high return on investment, high margin, low capital intensity. Smart parking offers intelligent technology solutions designed to manage car park environments. So smart parking sells this technology to businesses to manage their car parks, and it increases that business's revenue because they get a more free-flowing car park. So this company is only just started to tap into a very large global addressable market. Many of these car parks around the world are still very manual boom gate car parks, and we expect the share price to appreciate as they tap into that large market.
These are often the best opportunities on the ASX. We're obviously a small market in the scheme of the world, but sometimes there are these great companies that prove themselves in Australia. Because we're a small market, they have a small valuation, and then expanding offshore, we can really see an uplift in earnings and the share price. This is one of our highest weighting holdings in the high conviction portfolio, and we've got good expectations for this investment over the next 1 to 3 years. So just a few stock-specific examples, but thinking about the portfolio positioning, contains high-quality industrials like Smart Parking, Xero, Life360's, Webjet, which is going through a demerger next week, PolyNova, a company we've held for a long time, and they're accelerating growth into the global market. Premier Investments, one of the best retailers on the ASX, in our opinion, and a recent addition, Monash IVF, a great industrial as well. Recently, we've increased our materials exposure. We've got some examples there, South32, BHP, Chalice. Chalice, we're actually already taking profits. That's was a quick 20% uplift since we invested. And we're maintaining our financials underweight. They're still some of the most expensive banks in the world. CommBank, we've spoken about a few times before, 25 times earnings, 0% earnings growth. We think relative outperformance will come from not owning the banks in the future. It has made it difficult to keep up with the market. Since the financials have performed well, we're confident in our underweight position, and we think they're too expensive here. We've also reduced cash levels, which were around mid-teens for years now. They're now down to 5% based on an increased number of opportunities we're seeing in the market and a positive outlook in the macro. So just to conclude, August demonstrated a resilient economy. In reporting season, the Australian economy is in good shape and quality companies outperformed yet again. We see this most reporting seasons. They're expensive for good reason, and they prove to the market why in reporting season. We're seeing some opportunities in materials, which we've increased. We're underweight financials, and the rate cut cycle has commenced today with the Fed cutting 50 basis points. This macro setup is supportive for equities and especially holdings we have in the portfolios today. And we think it especially benefits our hunting ground, which is smaller companies which have been under pressure for years, and high quality companies which will grow earnings stronger than the market. That's all. Thanks for listening. We'll see you next month.